Let me ask you something uncomfortable. What if the safest place you've ever put your money is actually guaranteeing that you lose it? Not overnight, not in a crash, not in a scandal, but slowly, predictably, legally. It's called your savings account. Now, before you click away thinking this is exaggeration, let's use real numbers. In January 2020, you had $10,000 sitting in a savings account. You felt disciplined, stable, responsible. Fast forward to 2026. From 2020 through 2025, cumulative U.S. inflation has been roughly 22 to 25%, depending on the calculation method. In 2022 alone, inflation peaked above 9% year over year, the highest in 4 decades, even though inflation cooled into the 3 to 4% range during 2023 through 2025. Prices never went back down. They locked in. That means your $10,000 from 2020 now has the purchasing power of roughly $7,500 to $8,000. You didn't lose it in crypto. You didn't gamble it in options. You didn't panic sell. You did nothing. And you still lost, quietly. Now here's the part almost nobody talks about. During that same period, U.S. banks reported record net interest income. The difference between what they pay you and what they charge borrowers exploded as rates rose in 2022 through 2024. You earned 0.01% for years. They charged 7% on mortgages, 8 to 9% on auto loans, 20 to 22% on credit cards, and you thanked them for keeping your money safe. This is what I call the 1% secret. The wealthy do not store serious capital in savings accounts long term. They use them for liquidity. You use them as a strategy. That difference is costing you decades. And wait, it gets worse. Even when banks started offering high-yield savings accounts at 4 to 5% in 2023 through 2025, inflation was still running near 3 to 4%. After taxes, you were barely breaking even. You weren't building wealth. You were trading water. By the end of this video, you'll understand why savings accounts mathematically lose to inflation, how fractional reserve banking turns your deposits into profit engines, why debt compounds aggressively while savings decay slowly, how taxes deliver the final blow, and what serious capital allocators do differently. This isn't financial advice. This is financial reality. Let's destroy a myth. Your bank is not a vault. It's a lending machine. Modern banking runs on something called fractional reserve banking. When you deposit $10,000, the bank doesn't store $10,000 waiting for you. They keep liquidity reserves and lend the rest. Your deposit becomes someone's mortgage, someone's business loan, someone's 22% credit card balance. And here's the uncomfortable part. In 2020, reserve requirements for many banks were effectively reduced to zero. Banks now operate primarily on capital requirements and liquidity management, not one-to-one reserves. Translation: your money is fuel. You are the supplier. The product they manufacture is debt. Now let's talk margins. In 2025, average credit card APRs, roughly 20 to 22%. Auto loans, 7 to 9%. Mortgages, 6 to 7% range. Traditional savings accounts, often under 1%. Even online HYSAs fluctuate between 3.5 and 5%. The spread, called net interest margin, is the engine of bank profit. You deposit at 1%. They lend at 8%. They keep the difference. If you ran a business where raw materials cost 1% and you sold the finished product at 8 to 20%, you'd be unstoppable. And wait, it gets worse. When banks issue loans, new money enters the economy as credit. Money supply expands. When money supply grows faster than goods and productivity, inflation. From 2020 to 2022, trillions were injected into the U.S. economy through stimulus and asset purchases. Result: the fastest inflation spike in 40 years. Groceries surged, rent exploded, insurance premiums jumped. Your savings account didn't adjust fast enough to protect you. And here's the psychological trap. Banks sell you the word safe. Safe feels adult. Safe feels disciplined. But safe from what? Safe from volatility? Yes. Safe from erosion? Absolutely not. If inflation averages 3% long term, the Federal Reserve's own target, and your savings earns 1 to 2% after taxes, you are losing 1 to 2% of purchasing power annually. That compounds. And most people never calculate it. They just look at their balance going up and feel progress. But progress in dollars is not progress in purchasing power. And now we go deeper, the 1099 INT trap, the final blow. Let's say you upgraded. You found a high-yield savings account paying 4.5%. You feel smart, finally earning something. But here's the silent assassin. Every January, you receive a 1099 INT tax form. Interest income is taxed as ordinary income, not long-term capital gains, not qualified dividend rates, ordinary income. If you're in the 22% federal bracket and pay 5% state tax, you lose roughly 25 to 30% of your interest. Let's calculate. $10,000 at 4.5% earns $450 annually. Now subtract 25% taxes, you lose $112.50. You keep $337.50. Your effective return drops to 3.37%. If inflation is 3%, your real return is 0.37%. If inflation is 4%, you're negative. And wait, it gets worse. You're taxed on nominal gains, not real gains. If inflation erased $400 in purchasing power and you earned $450 in interest, the government still taxes the full $450. You're taxed on illusion. This is the final blow. Savings accounts don't just lose to inflation. They lose to inflation and taxes combined. Serious investors obsess over after-tax real return, not headline APY. What you keep is what matters. Let's run clean numbers. The saver, $10,000 in 2020, average 1.5% return over 6 years. $10,000 times 1.015 to the power of 6 is roughly $10,930. Now adjust for roughly 23% cumulative inflation. Real purchasing power is roughly $8,885. You made $930, but lost over $1,000 in real value. The debt holder, $10,000 credit card balance at 18%. $10,000 times 1.18 to the power of 6 is roughly $27,600. Debt compounds aggressively. Savings compounds weakly. System design. And wait, it gets worse. Stretch it to 20 years. Savings at 2%, $10,000 times 1.02 to the power of 20 is roughly $14,860. Inflation at 3% halves purchasing power roughly every 24 years. Rule of 72. You end with more dollars, less power. Now compare to 8% compounding. $10,000 times 1.08 to the power of 20 is roughly $46,600. Same starting capital, radically different outcome. The difference isn't intelligence, it's allocation. Asset versus liability. Deep dive. You have $10,000 in 2020. Two choices. Option A, buy a car. Cars depreciate 15 to 20% in year 1. After 6 years, your $10,000 car may be worth $4,000 to $5,000. You lost roughly 50 to 60%. Add maintenance, insurance, repairs, even conservatively, $1,200 per year. Over 6 years, $7,200. Your $10,000 decision likely cost you $15,000 to $18,000 economically. Inflation increased parts and labor costs during this period, so the liability became more expensive over time. Option B, buy a dividend aristocrat. $10,000 invested in early 2020. Assume 8% annual return, including dividends. $10,000 times 1.08 to the power of 6 is roughly $15,870. Dividends reinvested compound further. By 2026, realistically $15,000 to $18,000 range, depending on timing. No oil changes, no depreciation from usage. Now here's the painful truth. The saver lost purchasing power, the car buyer lost depreciation and opportunity cost. The asset owner compounded. Middle class formula: consume first, save second, invest last. Wealth formula: invest first, save for liquidity, consume last. Flip that order and everything changes. The story of average Joe. Joe graduated in the mid-1980s. Stable job, no speculation, no hype. He saved every year for 40 years. By 2025, Joe had $1.2 million. Disciplined, responsible, conservative. Back in 1990, Joe calculated he'd need $60,000 per year in retirement. Comfortable life. But inflation compounds. At 3% average inflation over 35 years, $60,000 becomes well over $140,000 in 2025 dollars. Joe retires, applies the 4% rule. 4% of $1.2 million equals $48,000 annually. Even 5% equals $60,000 in 2025 dollars. That doesn't buy what he imagined. Groceries higher, healthcare exploded, insurance doubled. And wait, it gets worse. Medical inflation historically outpaces CPI. Joe didn't fail. He underestimated purchasing power decay. He saved nominally, but planned in real terms. And millions are discovering this now. The global perspective. This isn't just America. Central banks worldwide target 2 to 3% inflation, not zero. That means erosion is policy. Europe, UK, Canada, emerging markets, different speeds, same direction. Simplified dollar milkshake idea. When global liquidity tightens, capital flows to stronger currencies like the US dollar. But even a strong dollar can lose domestic purchasing power. Relative strength does not equal absolute preservation. Globally, money supply expands over time. Debt-based systems require growth. Growth requires liquidity. Liquidity expands supply. Supply pressures prices. Cash becomes a melting ice cube everywhere. The wealthy globally hold businesses, equities, real estate, productive assets. Cash is transactional, not generational. And once you see that, you can't unsee it. Let's be clear. Savings accounts are not evil. They are misused. They are liquidity tools, not wealth engines. What do the wealthy do? Maintain emergency liquidity, 3 to 6 months expenses. Deploy excess capital into productive assets. Target returns meaningfully above inflation. Focus on after-tax real returns. Avoid high-interest consumer debt. Use strategic debt tied to appreciating assets when appropriate. They understand something most people don't. The biggest risk isn't volatility, it's erosion. If you leave $100,000 in cash for 30 years at 3% inflation, you effectively cut its purchasing power in half. Legally, silently, predictably. So, the next time you look at your savings account and feel safe, ask yourself, is this money waiting or is it shrinking? Because in 2026, standing still financially is not neutral. It's a decision, and the system profits from that decision. Now, you know.